this video, I'm going to explain a concept that is at the centerpiece of my investment strategy. Now, why should you care? Because by using this concept, you can live the rest of your life without paying capital gains tax on the sale of a rental property. The concept that we are talking about today is called the 1031 exchange. Every real estate investor should know what the 1031 exchange is. It should be an essential part of any real estate investor's investment strategy because it's so damn powerful. So with that said, let me show you what the 1031 exchange is capable of and how to use it in the most strategic way. By the way, my name is Michael. I'm a full-time software engineer in the Bay Area and a part-time real estate investor. I code during the day and pretty much during the night, I teach people why they should be investing in real estate if you want to reach financial freedom faster. So when it comes to buying an investment property, one of the best benefits you get as a homeowner is that the value of your home is going to go up over time. But if you go to sell that property for a gain, you have to pay what's called capital gains tax. And it's the exact same capital gains tax that you would have to pay if you sold a stock for a gain. You would also have to pay capital gains tax. However, unlike stocks, rental real estate has multiple ways for you to defer paying those capital gains tax until a later date. And the 1031 exchange is one of the best ways to defer paying capital gains tax on the sale of a rental property. So essentially what we're doing is not eliminating the tax bill, but we're basically kicking the can down the road. So the concept of the 1031 exchange is pretty simple. The idea is that you're going to take your investment property, which has hopefully appreciated by a little bit, and what you're going to do is you're going to exchange this property for a like-kinded property, most usually another investment property. So you'll exchange this property and basically buy another investment property. And what you can do is you can use the capital gains from the sale of the first property as a down payment for this new property. And the idea is you don't have to pay capital gains tax until you sell this new property. So one thing that I should mention is that the 1031 exchange tax code only applies to investment properties. And it's one of the reasons why I rent where I live and buy investment properties is to get access to the 1031 exchange. But there is a really great tax benefit for primary home owners, assuming that you didn't buy this house as an investment property. And if you want to learn more about that, you can go check out this video right here. So I've personally done a 1031 exchange once before, and let me break down the numbers for you so you can understand how it really works. So first off, I bought a home for $227,000, and I put roughly 20% down, or let's just say $45,000. And exactly 1 year after buying that property, due to a global pandemic, my home value went from $225,000 to about $485,000. So of course I wanted to lock in my profits, so I sold the home for $485,000. So while in the process of selling the home, I hired a 1031 exchange company. A 1031 exchange company is basically a third-party company that holds the profits and the proceeds from the sale of the first home. And they hold those funds until I've designated a replacement property. And when I go to buy that replacement property, then the 1031 exchange will release those funds so that I can buy that replacement property. The idea is that I personally never receive those proceeds. The moment I touch those funds, the 1031 exchange is voided and I now have to pay those capital gains. So if you're gonna do a 1031 exchange, hire a 1031 exchange company. So my capital gains was about $258,000 and I got back my original $45,000 down payment. So that means that I transferred a total of $303,000 to my 1031 exchange company when I sold my first home. Now, once you sell the property, the time starts ticking. And I say that because there are two critical milestones that you have to understand if you're gonna execute a 1031 exchange. The first critical milestone is the 45-day mark. Within 45 days of the sale of your property, you must designate the replacement property in writing to the 1031 intermediary, specifying the property that you want to acquire. Now, the second critical milestone that you have to be aware of is the 180-day mark. And that means that you have to close on this new replacement property within 180 days. So for me, I decided to take that $303,000 and go buy a single family residence in the Bay Area for $960,000. I used the full $303,000 as a down payment for this home, and my interest rate was about 3.75. So effectively what I did is I traded, or I exchanged, the $485,000 property for a $960,000 property in the Bay Area. And the great part is that I didn't have to spend any of my own cash to make that transaction happen. I just use the money from the sale of the first property as that down payment. Now remember, the 1031 exchange is a tax deferral method, which basically means that you're promising that you're gonna pay the taxes later on down the road. So if you were to sell this $960,000 property today for, let's just say, the same price that you bought it for, $960,000, then I would owe the taxes on that $258,000 of capital gains. But here's the catch. I don't ever plan on selling that asset. If anything, I'll just 1031 exchange it again for a bigger asset. And when then that property goes up in value, I'm just gonna exchange it again. So technically, I will never sell the property. So the concept of trading up for a bigger asset each time that you do a 1031 exchange is what I like to call the branching strategy. Now, if you really think about it, I essentially bought this $960,000 home for just $45,000. That's the only amount of cash that I had to pull out of my pocket, and now I own this $960,000 property. And the crazy thing is that this $960,000 property in about 10 years is gonna be worth, let's just say, $1.5 million. And that's crazy because if you total up my equity within that home, you have my $45,000 down payment, you have the $258,000 of capital gains from the first property, and now you have $540,000 of capital gains from the second property when it went from 960 to 1.5 million. That means when I sell this $1.5 million home, I'll have an exchanging power of $863,000 that I can go spend on another home as long as I'm doing a 1031 exchange. Not to mention, your tenant has been paying down your loan for the past 10 years. So let's just say they paid down about $100,000 off your loan balance within those 10 years, that means my purchasing power is actually $983,000. But remember, as soon as that $1.5 million property sells, you have exactly 45 days to identify your next replacement property and report that to your 1031 intermediary. So now the question becomes, how do you spend $983,000? And in my opinion, you really have two options here. Number one, you can decide to use more leverage and buy real estate. And option two is you can use less leverage to buy real estate. So obviously using more leverage means that you are still putting 20% down, and using less leverage means that maybe you're putting like 40% down or 50% down. If you take $983,000 and you put 25% down, that means you can purchase roughly about a $4 million property. But because you're using a relatively high leverage, your monthly payment on that mortgage is going to be very high. And so the monthly cash flow that you can collect from that asset is not going to be as much. Now on the flip side, let's say you use less leverage and you go put 50% down on a $2 million multifamily real estate property. Now, of course, with this option, you're not gonna be able to own as much real estate, but the good thing is that your investment is a little bit safer because your monthly cost on that mortgage is so low because you put 50% down, which means that your monthly cash flow is going to be higher in this scenario. So if you're getting older and you care more about cash flow and less about growth, maybe you go for option two, start to deleverage and start collecting more cash flow. But if you're young, maybe you want to consider going with option one, using more leverage and buying more real estate, because if the market goes up by 10%, your property is going to appreciate more than the person who bought $2 million worth of real estate. However, you have to realize that the more leverage that you take, the more risky your investment is going to be because your monthly payment is going to be higher. So you just witnessed how I was able to use $45,000 to buy a $227,000 property and eventually trade that $227,000 property for a $1.5 million investment property. And hopefully that $1.5 million property is maybe a multifamily property that produces a good amount of cash flow for me every single month. But here is the part that is going to blow your mind. I want to expand this concept of the branching strategy because we've only been talking about this one investment property, right? I bought a property for $227,000, and again, 30 years later, after several 1031 exchanges, I now ended up with this $4 million rental property. But I want you to imagine if you bought this same $227,000 property every single year for the next 10 years. The reason this strategy is called the branching strategy is because each time you buy a $220,000 property, you're essentially planting a seed. Then what you're doing is you're waiting for that seed to mature and appreciate and grow. Then when it's nice and ripe and juicy, you're gonna 1031 exchange it for a bigger and better property that can produce more cash flow. And when you have 10, 20, 30 of these branches working at the exact same time, you can imagine how fast your net worth is going to explode. So this is the most strategic way to use the 1031 exchange property. You just continue to buy properties, and each time that property is eligible for a 1031 exchange, you exchange it for a bigger property that can produce more income. That's why I always say, if you're paying capital gains tax in real estate, you're doing it wrong. So if you like these videos where I dive not into just the definition of the concept, but how to apply the concept strategically, then subscribe to the channel because there's gonna be a lot more videos like this coming. And as always, if you wanna schedule a one-on-one strategy call with me, the link is in the description below. And of course, if you wanna learn more about real estate investing and how I saved $100,000 in taxes in 2022, you guys can go check out these videos right here. So thanks for watching, guys, and I'll see you guys in the next video. Peace out, guys.